Hi, I'm Jim Jubak, and welcome to my YouTube video for June 2nd. If you want to see more of my stuff, more of my picks, more of my portfolios, you can go to my free site, jubakpicks.com. If you want even more, 6 portfolios instead of 3, more posts every day, you can go to my subscription site, subscribe at jubakam.com. Next week, we're going to do something a little different. Instead of producing a video, I'm going to be hosting a live Q&A right here on my YouTube channel and on Instagram. If you've got a question, just add it as a comment to this video or tune in live and ask your questions then. I'm going to be talking about inflation, shortages in supply chain, the screwed up supply chain, market volatility, the Fed, and anything else that you want. Details below. The topic is 4 picks to shoot the moon. Now, shoot the moon, for those of you who don't play hearts, is a high-risk hearts strategy. The point of hearts, one of my favorite card games and one of the few that my children would play with me, is to avoid taking any points, and especially to avoid the Queen of Spades. When you shoot the moon, however, the idea is that you're going to try to take all of them. It's a high-risk strategy with a high reward. You get an extra 26 points deducted from your score if you actually pull this off successfully. The thing is, you can't do it very often because people then figure out what you're doing. What I'm looking at today is 4 stocks that are really high-risk speculations, varying degrees of high risk, but all high risk. I certainly wouldn't want to build a portfolio around them, but if you have a solid portfolio and you've got some money that you can afford to lose, and it won't mean that you have to lose your house, these are potentially high profit returns if they work. The first 2 are in the tin industry, tin mining industry. Now, in all probability, you don't think about tin at all, but it is a very, very important industrial metal. 47% of all tin goes into solder, and that means it goes into virtually every kind of electronic device you can think of, including smartphones, 4G. What's interesting is that you're seeing demand for tin go up at the same time as supply of tin is constrained, and it's constrained by a couple of things. One is that China is one of the big producers, a company called Yunnan Tin, down in the southern province of Yunnan, which is going through a drought, and droughts are really tough on miners, so there's going to be some shortages down there. Indonesia is the world's largest exporter, and it's having problems getting the tin out of the country because of a shortage of supply ships. So it's a time when you've got shortages for tin, prices going up. On June 1st, a year ago of 2020, tin sold for $15,108 per metric ton. Today, June 1st, 2021, it sells for about $30,596, so about a doubling. If you're looking for tin opportunities, the problem is that it's not only is there a scarcity of tin, but there's really a scarcity of tin plays. You're really going to wind up investing in very, very penny stocks. We're not even talking about $5 a share. We're talking about literally pennies a share. The first one to look at is a company called Alpha Min Resources. The ticker is AFMJF, and the price right now is 62 cents a share. But you notice that along with the price of tin over the last year, the stock has gone up, up, and up. And I'm now going to say something that I've always wanted to say. The real danger to tin mining for this company is a volcano. It has a mine right near Goma in the Democratic Republic of the Congo, where there's been a big volcanic eruption. So they've been forced to shut some of their mining. They say they'll be back to full production in June, but meanwhile, they're not producing as much tin as they were pre-volcano. The risk here, besides the collapse of tin prices or the falling tin prices, is the Democratic Republic of the Congo is a really tough place to do business. If you're a foreign mining company, it's capricious. The mining laws are inequitably enforced. So that's a lot of risks there. If you want to avoid that risk and take on different kinds of risk, I've got another tin mining stock for you. This is called Metals X. The ticker is MLXEF. And what they own is a 50% stake in a joint venture that mines tin in Australia, specifically on Tasmania. It's called Renison Tin. And so therefore you're avoiding the China or the Democratic Republic of the Congo risk. You're basically getting just a more specific company risk. Now you notice that when we talk about shooting the moon on these things, you're talking about a stock where the low for 2021 is a little less than 9 cents, and then we get spikes like this and collapses like that. This is a very, very speculative play. Today we've gone from the low of 9 cents to a high of about 24 in 2021, and today we're trading at about 22 cents. The one big risk here is this company is not profitable. It has it's capital constrained, and it doesn't really have all the money it needs to develop this mine as quickly as it would like. There's about 8 years of resources at the mine. This is in a mine in Tasmania that's been operating for 40 years or more. So they can basically now apply modern technology to the waste products from earlier and recover more tin from that. So there's more there. And this is Australia's largest tin resource. So that's what you're getting here. They recently sold off, that is Metals X recently sold off all of its copper assets, so to become more, to raise money, to invest in this and to put money into tin. Those are my two tin shoot the moon plays. Next one I'm going to talk about is QuantumScape. Now I love this chart, is unbelievable. I own this stock. They went public using a SPAC, a special purpose acquisition company, specifically one called Kensington Capital, and they went public in October. So if you, I owned Kensington before that, watched the conversion, watched it rise, and I sold on November 30th at about $47. So I had a 204% profit. I thought that was enough. Of course, it means that I missed this whole spike. But I've been watching, because I didn't think the spike was sustainable. I'm watching as it comes down and down and down and down and down. And we're now at 26, 25, way below where I sold back in November, and I'm looking at it again. The risk here is really a technology risk. This is a development stage company that's producing a solid state lithium battery. Solid state means that it's safer than current lithium batteries, should recharge faster, and it offers a lot of advantages. Solid state lithium is probably the next big step in battery technology. The company says that it won't go into production on these batteries until 2024, so you're buying a development stage company. This has caused a lot of bears to basically say, hey, this company's a scam. We all know that SPACs are Ponzi schemes. Well, no, what we really got here is a development stage company with pretty solid backers. Volkswagen has put $100 million into this company. So you're really looking at a company where you can't say, hey, the product is XYZ, because there is no product yet. They're still developing. They've got to get this battery to work, they've got to stack layers. They've got to stack roughly 10 layers. They've stacked 4, good progress. They've met a couple of benchmarks. So you're betting on that technology to work. And you're talking about as they are able to make announcements about the technology, as they get closer to production in 2024, you could certainly see the stock easily double. But there are a lot of bears gunning for this one. And the big risk here is actually the fact that it's a development stage company, but it's got a really high market cap already. It's got an $11 billion market cap, which is extraordinarily high for a company without a product yet. Makes it vulnerable on the downside, makes it vulnerable to bear attacks, and also increases your risk because maybe it won't work. Okay, the fourth one is a company with a different kind of risk, not a product or technology risk. This is Oatley Group. This is a Swedish company that is the dominant player in oat milk and oat dairy. They recently went public. They went public on May 20th at $20.20 a share. It's way back here on the chart. And you see it's moved up today. We're at about 24.53 at the moment. Now, the rub on Oatley, or the rubs on Oatley, one is that it's expensive. The market cap is already about 14.5 billion. A lot of money for a company that isn't yet profitable. You compare that to Beyond Meat, another meat alternative company where the market cap is only 8 billion. Beyond Meat isn't profitable yet either. The thing that you're looking at in terms of Oatley is that they've got really big ambitions. So they're looking at capital spending mostly on marketing of about $1 billion over the next 3 years. So they're not only not profitable this year, they're not going to be profitable in that time period either. What they're trying to do is to grow both their presence in the oat milk dairy sector, as well as to grow oat milk dairy as a whole. Oat milk products are about 14% of plant-based retail market right now. That's growing. The total global plant-based dairy retail market, so this global plant-based dairy retail market was 18 billion in 2020. Oatly's sales in 2020 were 421 million. So you've got 18 billion market size, $421 million in sales. They grew revenue by about 2 times from 2019. So what you're buying here is a lot of potential growth, not much potential profitability for quite some time. And the risk is that you're already paying a pretty decent price. The typical pattern of a hot IPO, and I think this is one, I think there are a lot of people who say plant-based alternatives to meat and dairy are the next big thing. So I think, and there aren't a whole lot of stocks to play that. There's this one, Beyond Meat, and a few others. So I think you're looking at a run-up period as people put some money into this because they like the prospects. Remember that that typically in about 6 months after the IPO, you've got a lot of lockups that expire and a lot more shares come on the market. So you might want to hold this one from now until, say, October, and then maybe get out and see what happens in November, and then maybe get back in again. So anyway, this one's a little tricky in terms of timing, but I think the potential for it being a shoot the moon play really high. See you next week. Plus, if you want to follow me in the interim online, you can go to my free site, jubakpicks.com, or you can subscribe. You get more picks, more portfolios, more posts on my subscription site. That's jubakam.com. And also remember that next week I'm doing a Q&A rather than a produced video. So if you have a question that you'd like me to talk about on subjects from inflation to central banks to the kind of shoes that Jerome Powell wears, to supply chain problems, to market volatility, please just add them to the comments below, or actually tune in on the day of the Instagram and YouTube video and ask them then, and I'll do my best to answer them. Okay, see you next week.